Let's start today's lecture about financial accounting. This is the second live transmission on the free course of financial accounting. Let's recap what we learned in yesterday's class. We first discussed the course outline of this course, which comprises basic concepts, accounting cycle, preparation of financial statements, bank reconciliation statement, rectification of errors, and the bill of exchange. Then I asked you to prepare to have at least these three things all the time. Number one, a calculator, a notebook, and a pen. Then we discussed two main topics yesterday. First was the 5 elements of financial accounting. Okay, which were income, expense, asset, liability, and owner's equity. Then I told you the some examples of these elements. For example, income means salary income, sales, and interest income. Expenses includes electricity bill, telephone bill, insurance premium. Assets include your house, your car, your furniture, your building, your land, etc. Then liability includes that when you owe the money to the supplier of the goods from which you purchased some material. And owner's equity means anything in cash or in kind which the owner of the business introduces into his business. Then the second thing which we discussed in yesterday was the types of the business. There are three main types. Number one is sole proprietorship. Any business which has a single owner is called sole proprietorship. The second kind is partnership. Any business who has more than one owners is called partnership. And the third one is joint stock company. Joint stock company may have many owners, even in thousands or millions. And the owners in this type of business are called shareholders. Okay, so these were the two main topics from the yesterday's class. In today's lecture, I'm going to introduce some more concepts which we regularly use in the accounting subject. So let's write it down. The more accounting concepts. Number one is very famous in accounting, which you will use regularly. It's called purchases. Okay. Now what purchases are? In accounting language, the word purchases has a special meaning. When saleable goods are bought in a business, it is said that purchases have been made. For example, to a cloth dealer, whenever cloth is purchased, it will not be necessary to mention that cloth has been purchased. Simply, we will say that purchases have been made. So, on the other hand, if some stationery is purchased, then it will be essential to mention that stationery has been purchased. Okay. The second concept is cash purchases. If goods are purchased from a supplier and payment is made to him at the same time, such purchases are known as cash purchases. For example, if Mr. X purchased goods from a seller, Mr. Y, for rupees 5,000, on 1st January 2025 and the payment is made to the seller, that is Mr. Y, at the same date, that is the January 1st 2025, it will be a case of cash purchases. Then the third concept is credit purchases. If when goods are purchased from a seller and payment is not made to him at the same time, rather the payment is arranged to be made at some other future date, such purchases are known as credit purchases or purchases on account. For example, Mr. A purchased goods from Mr. B for rupees 5,000 on 1st January 2025 and Mr. A agreed to make the payment of goods on 15th January 2025. It means that the payment has not been made on 1st January, so it will be a case of credit purchases. On 15th January, Mr. A will pay rupees 5,000 to Mr. B. Okay, the fourth concept is purchases return or return outward. As you can guess something that goods once purchased may subsequently be sent back to the seller for certain reasons. For example, the goods are defective, the goods are not according to the specification, the goods are damaged or below standard. Such returns of goods to the seller is known as purchases returns or returns to supplier. For example, we purchased 100 radio sets from a radio supplier for rupees 15,000. On receiving the delivery of goods, it is found that 10 radio sets are of inferior quality. The return of these 10 radio sets to the seller will be a case of purchases return. Okay. The next concept is purchase discount and sale discount. The concession given by the supplier to the buyer on purchases of goods is known as purchase discount to the buyer and sale discount to the seller. The next concept is allowances. Sometimes the customers, that is the buyers, find that goods purchased have minor defects. In that case, the seller may agree to reduce the price of damaged or defective goods to induce the buyer to keep the goods. Such reduction in price is known as purchase allowance to the buyer and sale allowance to the seller. The next concept is sales. We know that goods are purchased for selling purposes. When these goods are sold to customers at a specific price, it is said that sales have been made. For example, we purchased goods worth rupees 5,000. These are our purchases. And suppose these goods have been sold at a price of 6,000. In accounting language, it will be said that sales have been made at rupees 6,000. So goods sold are called sales. The next concept is cash sales. If goods are sold to customers at a specific price and the price of the goods is received from them at the time of sale of goods, such sales are known as cash sales. For example, if we sell goods to a customer, Mr. A, for rupees 2000 on 10th of January and receive the cash from him on the same date, it will be a case of cash sales. Then next come is credit sale. If goods are sold to a customer and he does not pay the price of goods at the same time but agrees to make payment on some future date, the sales are called credit sales or sales on account. For example, we sold goods to Mr. X for rupees 30,000 on 15th January 2025 and he agreed to make payment on 31st January. It will be a case of credit sales or sales on account. The next concept is sales return or return inward. If a customer to whom goods have been sold finds that the goods are defective, unsatisfactory, below standard, or not according to the specification, he may return these goods to the seller. To the seller, such return of goods is known as sales returns or return inwards or return from customers. The next concept is very famous, which is trade discount. At the time of selling goods, the manufacturer or wholesaler allows the buyers such a discount or concession. It is allowed at a certain percentage of the listed price. For example, the list price of the goods is rupees 30,000 and the wholesaler allows trade discount of 10% on the listed price to the buyer. It means that net price of the goods is 20,000. The trade discount enables the retailer to sell goods at the listed price, and the customer can be sure about the fair price of the goods. It may be noted that both the buyer and seller will record rupees 20,000 in their books of account. In other words, trade discount is not recorded in books of account. Thus, discount allowed by manufacturer or wholesaler at the time of selling goods to retailer as a deduction from the listed price is called the trade discount. The next concept is debtors or accounts receivable. When goods are sold to customers on credit basis, that is, the credit sales are made to customers, debtors come into existence. Debtors are the persons or customers to whom the goods have been sold on credit basis and from whom the business is to receive money in near future. The accounts of such customers are known as accounts receivable. For example, we sold goods to Mr. A for rupees 30,000 to Mr. B for rupees 20,000 and to Mr. C for rupees 40,000 on credit basis. The amount receivable from them, that is Mr. A, B and C, is known as debts, and the three customers A, B and C are our debtors or accounts receivable. The next concept is creditors or accounts payable. When goods are purchased from supplier on credit basis, creditors come into existence. Creditors are the persons or suppliers from whom we have purchased goods on credit basis and to whom the money is to be paid in near future. The accounts of such persons are known as accounts payable. Accounts payable means the amount which a business expects to pay to its suppliers for goods purchased or services received from them on credit basis. So the person or business who will receive the money in near future is called creditor, and the person or business who will pay the money is called the debtor. Now let's discuss the next concept, which is cash discount. It is a deduction or allowance given by a creditor to a debtor if the amount due is paid by the debtor before the due date, or it is a reduction in price, usually 2% or less, offered by manufacturers or wholesalers to encourage customers to pay their debts within a specified discounted period. For example, Mr. X sold goods to Mr. Y for rupees 1000 on credit basis. It means X is a creditor and Y is a debtor. X offers an allowance of 2% to Y if he will pay his debt within 15 days. It means if Y pays his debt within 15 days, then he will pay only rupees 980 after the discount of 2% to Mr. X. Such a discount is known as cash discount. So these were the main accounting concepts which we will be using in our day-to-day accounting in our future lectures. Let's recap what we have learned today. We have learned some terminologies. Number one is purchases, cash purchases, credit purchases, purchases return or return outward, purchase discount and sale discount, allowances, sales, cash sales, credit sales, sales return or return inward, trade discount, debtors are accounts receivable, creditors are accounts payable, cash discount. So these are the concepts for today's lecture. Tomorrow I am introducing you with some accounting principles, and we will further advance with our accounting. Until then, take care. Goodbye.